A 74-year-old woman entered her neighborhood bank last spring to withdraw money that belonged to her. The bank declined, and it wasn't due to insufficient funds, but because of a rule that 7 federal agencies quietly approved in 2024, and nearly no one over the age of 60 has even been told it exists. I'm going to explain exactly what happened to her in just a few minutes. But first, I need to guide you through some context because the ending of this story is going to matter. And I want you to understand the full picture before we reach it. I'm Nancy, and this is Senior USA Hub. Last month, I posted a video about the $10,000 bank rule. Over 200,000 of you watched it. Since then, I've noticed a surge of other channels sharing their own versions on the same topic. Some are accurate, some are seriously misleading. I saw one recently that described a retired couple getting a letter from the government, a letter that federal law actually makes illegal for any bank to send. I'll come back to that shortly as well. But here's the part I need you to grasp first because everything else in this video only makes sense once you hear it. The $10,000 threshold has not changed since 1970. Back then, $10,000 was more than most Americans earned in an entire year. That amount could purchase 2 brand new Cadillacs. Gas was 36 cents per gallon. A home cost about $23,000. That was the environment this rule was created for. Drug traffickers carrying suitcases full of cash. Not a retired teacher selling her late husband's pickup truck. That number has never been updated. Not once. Last year, the Government Accountability Office, the federal government's own independent watchdog, reported that if Congress had adjusted the threshold for inflation the same way Social Security is adjusted, it would be closer to $73,000 today. Instead, it's still $10,000, which means that in 1970, the rule targeted criminals. In 2026, it catches your grandmother paying a roofing contractor. I'm not saying that to scare you. I'm saying it because everything I'm about to explain only makes sense once you clearly see that picture. The rule is outdated. The world around it has changed dramatically. And that gap is why things are becoming more unusual for retirees standing at a bank counter. All right, a quick recap for anyone who missed the first video. The $10,000 rule states that any cash transaction above that amount in a single day triggers an automatic report called a currency transaction report. The bank files it. It goes to FinCEN, which is a bureau within the Treasury Department, not the IRS. The report is automatic. Banks file millions of them. On its own, the report means nothing. The issue, as I covered last time, is structuring. Breaking up a deposit to stay below the limit is a federal offense, even if your money is completely legitimate. If you didn't see that first video, the link is below. Watch it after this one. Here's what I want to focus on today. 3 things have quietly changed since I posted that first video. I'm going to walk you through each one. Then, I'm going to correct 3 pieces of misinformation I've seen spreading this month because any one of them could cause you to make the wrong move. Let's begin. Change number 1, your bank can now put a hold on your own withdrawal. In December 2024, 7 federal agencies, the FDIC, the Federal Reserve, the CFPB, the OCC, the National Credit Union Administration, FinCEN, and state regulators released a joint guidance statement. That statement advised banks that they are encouraged to place holds on transactions when they suspect an older adult may be experiencing financial exploitation. Depending on your state, that hold can last anywhere from 15 days to 45 days. Florida law allows up to 45. Georgia and Kansas allow up to 25 business days. Other states have their own specific rules, and here's why this matters. More than $27 billion in suspicious activity tied to elder financial exploitation moved through the banking system in a single year, according to FinCEN's own data. The holds are meant to prevent scammers from draining accounts belonging to seniors. That's the positive side of this story. Now, let me share the story I mentioned at the beginning. I'm going to call her Margaret. Margaret isn't one specific person. She's a composite created from situations I've encountered, put together so you can clearly recognize the overall pattern. Last spring, a storm passed through her area and damaged part of her roof. A contractor came to her door a few days later, inspected the damage, and said he could fix it for $18,000 in cash. Margaret had the money. She had been saving it for years. She went to her bank to withdraw it. The teller called the branch manager. The manager brought Margaret into a private office and started asking questions. Who is this contractor? How did you find him? Has he been to your home before? Did he ask specifically for cash? Then the manager said, I'm sorry, ma'am, but under our updated procedures, we're placing a hold on this withdrawal for 15 days while we review this. Margaret was furious. And honestly, that reaction makes sense. She kept saying, This is my money. I earned it. I need it now. And every word of that was true. Here's where the story shifts. About a year earlier, when Margaret opened a new certificate of deposit at her bank, an employee had asked if she wanted to add a trusted contact to her account. She listed her son. Just a name and phone number on a simple form, 5 minutes of her time. Most seniors don't even know this form exists. During the 15-day hold, the bank contacted her son. He asked a few questions, and within 20 minutes, it became clear that the contractor had changed his price 3 different times, had no business license anyone could verify, and had told Margaret he only accepted cash because the IRS was after him. It was a scam. The roof wasn't even damaged the way he claimed. Margaret would have handed over $18,000 to someone she would never see again. The hold prevented it. Her son stepped in. She kept every dollar. But consider the alternative version of that story. The version where the contractor was legitimate, where Margaret was simply paying for real work on her actual roof, and the bank held her money for 15 days with no trusted contact available to resolve it quickly. That version is happening to retirees somewhere in this country every single day. The difference between those two outcomes is one form, one name, one phone number. We'll return to that form. Keep it in mind. Change number 2, Venmo, Zelle, PayPal, Cash App. About a third of the messages I received after my first video were some variation of this. I heard the IRS is now monitoring every payment over $600 on Venmo, so I stopped sending birthday money to my grandkids. Listen carefully. That is incorrect. And I don't want anyone stopping support to family because of something they saw online. Here's what actually happened. For several years, there was a proposal to lower the reporting threshold on these platforms to $600. That proposal kept getting delayed. Then in 2025, Congress passed legislation called the One Big Beautiful Bill Act that completely reversed it for 2025 and beyond. Venmo, PayPal, and Cash App only report to the IRS if you receive more than $20,000 and complete over 200 transactions in a year, and only for payments categorized as business-related. Personal payments between family and friends are not reported as income. Zelle doesn't send those forms at all because it operates through direct bank-to-bank transfers. It's not a third-party processor like the others, so if you send your granddaughter $300 for her birthday, it's not appearing on any IRS income record. If your son sends you $5,000 through Venmo to help with a medical bill and marks it as personal, that's not on any IRS income record either. Continue supporting your family. The $600 rule never took effect. I know this is a lot. Stay with me. The protective steps at the end of this video are things you can apply this week, and they tie everything together. Change number 3, the pattern detection software inside your bank has become much more advanced. And this is the one costing everyday people real money. Not because of a new law, but because of software upgrades almost no one is discussing. Let me tell you about Terry DeCo. Terry owned a small grocery store in Fraser, Michigan, and operated it for 3 decades. He was in his 70s. In 2013, the IRS seized about $35,000 from his business account. Not because he did anything illegal, but because his deposit pattern resembled structuring to their software. Terry had an insurance policy that limited cash coverage to $10,000, so he deposited below that amount. An algorithm flagged it. The government took his money. It took 2 years of legal work and help from a public interest law firm called the Institute for Justice to recover it. Terry's case isn't unusual. A 2017 audit by the Treasury Inspector General found that in the majority of structuring seizure cases reviewed, more than 9 out of 10, the money had been legally earned. These weren't criminals. They were grocery owners, farmers, small business operators, and retirees whose deposit patterns matched a pattern on a computer. Here's why this matters in 2026. The software is far more advanced now than it was when Terry was flagged. It detects smaller patterns. It cross-references activity across branches. The legal threshold is still $10,000. That hasn't changed. But the bank's internal monitoring systems are closely watching amounts well below that number, which means the advice that once seemed reasonable, just stay under the limit, is exactly what can get your account flagged today. All right, 3 changes covered. Now let me correct 3 misconceptions spreading online. Myth 1, the threshold dropped to $7,000. No, the law still states $10,000. A bank's internal systems may flag lower amounts, but the legal reporting threshold has not changed since 1970. Myth 2, your bank will send you a letter telling you a suspicious activity report was filed. This is a major one, and it's false. Federal law, specifically Title 31 of the United States Code, Section 5318, makes it a crime for any bank employee to disclose that a suspicious activity report has been filed. So when you see a video describing a retired couple receiving that letter, it cannot be accurate. What you might receive instead is a source of funds letter, which is a standard request for documentation. You provide your paperwork, the issue is resolved. Completely different situation. Myth 3, if you're over 65, the government is watching your account more closely than others. That's not accurate either. The elder protection guidance is meant to protect you from scams, not monitor you. The extra attention on senior accounts is designed to keep predators away from your money. And if you use the form I'm about to explain, you control that protection, not the bank. Which brings me back to that form. This is the most important thing I'll share in this video. Go to your bank this week. Ask for the Trusted Contact Designation form. Don't call it a senior safe banking authorization. That term is circulating online, but doesn't match any real product at major U.S. banks. Someone made it up. The correct term is Trusted Contact Designation. Every major bank offers it for free. You fill it out once. You write down the name and phone number of someone you trust, usually an adult child, sibling, or close friend. That person does not gain access to your money. They can't sign anything. They can't see your balance. What they can do is answer the phone when your bank calls. And that one call turns a 15-day hold into a 20-minute conversation. Here's the 4-word summary of everything today. State your purpose at the counter when making a large transaction. Avoid splitting deposits. File your documentation the same day. Elect a trusted contact for every account you own. State, avoid, file, elect. That's the entire plan. One final thought before I finish. In October 2025, a bill was introduced in Congress called the Streamline Act. If passed, it would raise the $10,000 reporting threshold to $30,000 and require adjustments for inflation every 5 years. I don't know if it will pass. I've been disappointed before, but I want you to know the conversation in Washington is finally moving in the right direction. The rule created in 1970 might finally be updated for today's world. If that happens, I'll let you know. You spent your entire working life building this money. You raised a family with it. You saved it through decades when saving wasn't easy. You shouldn't need a lawyer just to move it. You shouldn't feel uneasy walking into your own bank. You just need to understand what almost no one is telling seniors right now. And now you do. Leave a comment before you go. Tell me your state. Tell me the largest transaction you're worried about right now. I don't have a team reading these. I personally read everyone. The situations that appear most often shape the next video. If your situation is complicated, if you're unsure how this applies to your life, write it in the comments. Someone else is likely facing the same issue and doesn't know how to ask. You might be the one who helps them. The next video I'm working on breaks down the exact source of funds letter your bank sends when they need an explanation, line by line in plain language. So if one arrives in your mailbox, you'll understand it before opening it. If you know someone over 60 who moves significant money through their account, a parent, spouse, neighbor, or friend, please share this video with them. That trusted contact form could be the most valuable 5 minutes they spend all year. I'm Nancy. This is Senior USA Hub. I'll see you in the next one. And please subscribe to my channel for more helpful content.